we are seeing evidence of disinflation starting to materialize, meaning that inflation might be cresting and then kind of stabilizing at least for a period of time. So you could get disinflation doesn't mean deflation; it just means less inflation, like less rate of change. And so the way I would describe it is that the supply side remains largely unresolved. We basically have various supply side limitations, especially as it relates to energy and commodities. But there's the demand component, and by tightening up fiscal policy, just kind of in an intermediate way, and by tightening up monetary policy, they're basically taking some of the demand off. But that essentially means a recession.
In July, gas prices dipped in the U.S., bringing down the annual rate of inflation to 8.5%, still one of the worst rates the economy has seen in decades, but lower than the 40-year high peak it hit in the previous month. In June, the annual rate of inflation hit a 40-year high of 9.1%, with energy prices as high as over 70% compared to the same period in 2021. The official stance, no thanks to July's 528,000 jobs report, remains highly optimistic with claims that we've seen the worst of the price hikes and everything is slowly going back to normal. But experts believe the story to be otherwise. In fact, there have been quite a few conjectures that the energy crisis has been intentionally orchestrated to further push the green energy narrative and force consumers to move from fossil fuels. Many experts have also pointed out that inflation is, in fact, much higher than we've been led to believe. In a recent interview, Lyn Alden, macro guru and founder of Lyn Alden Investment Strategy, speaks at length about the current state of the U.S. economy. She explains that with July's inflation figures, the economy seems to have entered into a disinflationary period, where inflation is still a threat to consumers and the economy, but is dropping. However, Alden also notes that the economy is still in pretty bad shape, with both inflation and recession posing high risks that could send us back to June highs or a nasty economic decline. Ensure you watch this video to the end as the brilliant macroeconomist delves deep into the economy, offering an insight that could help investors make the right investment choices during these uncertain times. If you like this video, please hit the like button and subscribe for more videos. You can also drop your comments and observations in the comments section below. Thanks and enjoy the video.
Yeah, so I think to the first part of that, I think the inflation's absolutely real. If anything, I think the headline numbers that we see somewhat understate the actual inflation, in large part because of the shelter component. So it's kind of a wonky way for them to calculate it. And it somewhat understates and smooths out changes in house prices compared to how it used to be calculated. And so I think, the quote unquote real inflation is probably at least in the low double digits. So, kind of a few hundred basis points higher than it is now. But of course, everyone has their own, individual inflation basket because they all have their own, different things that they buy at a regular basis, the different weightings that they assign in their daily life. So there's no kind of one inflation metric, but I think if we were to have kind of a more consistent reading, we'd be at a slightly higher figure. Another thing that I think people have to keep in mind is that the Strategic Petroleum Reserve is still being drawn down, and that's still expected to continue for a little while longer. And so that's putting somewhat downward pressure on oil prices. So I think right at the current time, I think we hit kind of a fever pitch in terms of inflation. And now that it's rolling over somewhat, but I think that the problem is that it's kind of like holding a beach ball underwater. It's ready to return as soon as they kind of let go of some of those levers. And of course, there's other variables too. We have to see what happens out of China, right? Because China is a huge demand source for commodities and energy, and they're showing weak economic data as well. Obviously, the one spot where there's still huge inflation risk more than anywhere else is probably Europe. Because they have the most severe supply side limitations. But I think that's kind of where the data is pointing at the current time.
One thing that has been clear since the onset of the economic woes in the United States is the fact that consumers have little trust in policymakers. This is primarily because of their poor track record with correctly handling the situation when the need arises and because they stuck with their guns about inflation being transitory when it was obvious it was not. Then, there is the issue of the midterms, which many people believe is the reason why the present administration is trying so hard to the situation is. Please listen as Lyn Alden speaks about the Federal Reserve's inflation tackling strategies and how they impact the economy.
So I think they can take action around the margins. And I think we're seeing that show up in the housing market, for example, how that impacts, mortgage rates and things like that. This partially from private market forces and then partially from those kind of more central forces. And I think, basically they have a number of tools to kind of rein in demand And in their view, they want to try to use them moderately. But of course, if you look at the historical track record, soft landings are rather rare in U.S. Economic history, right? Usually they tighten into a recession because during the loosening phase, they basically encourage debt accumulation, and then they tighten the screws on anyone that actually took out debt in that environment. And so I think we're seeing that play out now. We're seeing a cooling off in the housing market. We're seeing some softness in the labor force around the margins, at least. So especially when you look at initial jobless claims each week, labor force participation, job openings. Ever since March 2022, we've seen kind of a softening in there. And so I do think it'll be quote unquote effective around the margins for, temporarily reining in inflation. But I think it comes at the cost of either significant economic slowdown or an outright recession. And I think that that's kind of sort of the environment they're in now. My kind of base case is that, so we've had 2 quarters in a row of, negative real GDP growth. It's a little tricky because we came off such a sugar high. And so, for example, most recessions, not all, but most recessions, they also go, negative year over year real GDP. We haven't hit that threshold yet. That's kind of like another arbitrary threshold. The very mild 2000s recession actually didn't quite hit that either. But like so far we have not kind of reached that threshold. But I think that if this kind of trend continues, I think we can kind of trend in that direction. And you could certainly have a kind of like a double dip recession where you have, say, 2 negative quarters and then a slightly positive quarter and then another negative quarter, and you can kind of like, bounce along this weak path. But so far the data is still deteriorating. Basically rate of change data is still showing overall kind of weakening prospects. When you look at PMIs, when you look at like producer prices paid, basically we're seeing a disinflation impulse, but not really for good reasons. More so due to the demand destruction rather than the supply constraints easing.
As Lyn Alden has explained in her interview, despite July's inflation figures, it's not yet time to break out the celebratory champagne bottle. The economic woes are far from being over, and we could very much be facing a greater collapse before we begin a slow, painful recovery. What are your thoughts on Lyn Alden's interview on the current state of the U.S. economy? Please drop your thoughts and observations in the comment section below, and don't forget to subscribe to the channel. Thanks for watching.